We're going to look at some examples here. So we're actually going to scratch these. We're going to look at an actual case study, which was a lot of fun. So I was recently working with another agent in my office with a nice guy, 47 years old, very, very technical, likes to see the internal rates of return, annual, average. We went through with him. We looked at both MassMutual and Guardian, and he's got kind of a unique situation where ultimately what he really liked was a policy with MassMutual where he funded it with $50,000 per year for 15 years. He might fund it for a shorter period of time, but he likes that idea of going for 15 years. And I asked, 15 years, you're going to want to fund beyond that? He goes, probably not. Like, I'm going to retire. It could be earlier. I might retire 2 years after the 15-year funding period, but I like that product with MassMutual, that 15-pay product. And then when we looked at Guardian, he liked the idea of really getting money that he just had in cash into the product over a short period of time, $100K per year for 3 years, nothing thereafter. But he's got that flexibility with Guardian. A specific question he asked was, if I want to keep paying the base premium of about $10K, can I do that? Yes. Can I keep adding up to $100K or more money if I wanted to? Yes, with how that policy is designed, no problem. So we're going to look at that, and we're going to look at the internal rate of return and the total or the net cash value growth. So let's have some fun with this one. And back on the original topic here of dividends, if I have a dividend rate of 6%, or if I have a dividend rate of 5.65%, will I see my money actually grow by that? No. I only wish I would. So let's take a look at the illustrations first, just to validate everything here, because this was a very fun case. Let's start with the MassMutual policy. So he was interested in funding a policy at $50,000 per year, and we looked at a variety of different funding scenarios for a longer period of time, shorter period of time, and he really settled on that 15-year funding period. That's the longest he wants the option to be able to actually pay money into the whole life insurance policy. So as we look at the actual design of the product, what do we see here? Where is the money going? I'll always emphasize this because this is how you get the overall strongest cash value with a whole life insurance policy. Here's your base premium, $5,000. We've got that at 10% of the total desired payment. Then we've got lister attached. That's a combination of a 1-year term rider and PUAs going into the policy. The cost of the term is minimal in this example. We've got $300,000 of term. That's going to be not even $1,000 per year, of which we're broken up there, percentage toward term, everything else going toward PUAs. Then you've got their basic AILR rider, additional life insurance rider, that's a pure PUA, and then a renewable term rider as well, which has a level premium for the first 10 years, net of $50,000 going into the policy. Okay, so breakdown of the policy. Let's go through this, or that was a breakdown. Let's take a look at the actual numbers here. As we scroll down, what do we see here? First off, bottom right-hand corner, MEC limit, $51,000, meaning he's paying in $50,000 per year. The death benefit, he said, okay, I'm mainly interested in the cash value. The death benefit is a cost. So in order to maximize cash value, I want to minimize the death benefit, which minimizes the costs as much as I can. But I don't want to go too low because that death benefit has a direct relationship to the MEC limit on a life insurance policy. So right now we've got that death benefit set at the minimum to give him a $50,000 MEC limit. It was a little bit higher, $51,000, which does not make much of a difference. But point is, minimum amount of life insurance to minimize the costs and maximize the cash value. So continuing on, here's my money column. When we look at all of these illustrations, year one, he pays in 50 grand. His cash value, $44,000 and change. That's pretty strong. He's close to 90% right off the bat. Now, as we continue on here, what's his break-even point? Between years 4 and 5. By year 4, he's paid in 200. He's got 196 and change. By year 5, he's paid in $250,000 and he's got $253,000. Now, if he wants to stop at this point in time, he can stop easily after 2 or 3 years. But if he wants to stop here, he can do that. If he wants to continue to pay $50,000, he can do that. If he says, I funded it at $50K per year, total of $250,000, I just want to pay in the base premium of $5K, or I just want to pay in $20,000 per year, he can do that. Both his contract language and the way the product is designed permits for all of that. So, fun stuff there. Let's continue on and see the values here. We're going to pull it up on the Excel spreadsheet, but this just allows us to see everything side by side here. By year 15, total cash value, he's paid in $750,000 and he's got $983,000. That will change because dividend rates will adjust over time, but this is where it comes down to the tracking of actual performance on the policy. So that's the MassMutual illustration. As we progress on to the Guardian illustration, both were run at preferred non-tobacco, that's regular preferred, second best class. Here's my base premium, $9,000 and change, because we can pay 10x that amount into the PUA rider. Here's my whole life death benefit, term rider to raise the total death benefit, which does guess what? Raises the MEC limit. So this policy as well, we have a MEC limit of almost exactly $100,000, a little overinflated. So with the Guardian policy, his plan is actually to move money he has in cash into this product, just a lump sum of cash in his bank account. But he also has the flexibility. What he really liked the idea of is, one, getting the money into the policy, $100K per year for 3 years. There's my cash value. Breaking even between years 4 and 5, that's great. Beginning the 4th year, he had this question and he asked it several times, mainly because he wanted to confirm it. Can I keep adding money? Like, what's it look like, Steve, if I keep adding $10,000 per year? He can do that. He can even continue to pay $100K per year, provided a term rider is attached. And if he does that at $100K per year, it's going to last him between 6 and 7 years. So he can really fund it well beyond expectations. But he might do something like this, 10K per year, or maybe it's 30K per year thereafter. He can bounce up and down. He can easily pay that minimum premium plus the minimum PUA rider, which is less than 10K per year in this case, and then add more funds whenever he wants. And when we scroll down here, here's your cash value and death benefit, which we then just exported everything to Excel. So MassMutual's dividend interest rate was what? Is what, I should say, 6%. So we've got a 6% dividend interest rate, and then Guardian has 5.65%. When we look at these products, because he's going with both, he likes the idea of diversifying. $750,000 going into the policy over 15 years. Year 1, he pays in $50,000, $44,000 in change in cash value. Dividend rate for this particular year is 6%. Yet the net internal rate of return, if I'm laser focused on the cash value, is negative 11.62%. Both the annual and average in first year, because I've only got 1 year to average out. That's why the first year is always the same. Time passes by between years 4 and 5. This assumes the same dividend rate is applied forever, which will not happen. Look at that. So I've got a dividend of 6, but my net annual internal rate of return that year is just under 2.6%. So after all of the insurance expenses, PUA fees and everything, that's what my cash value grew by net in policy year 5. And that's my average internal rate of return as I've now overcome the initial insurance expenses, starting to pick up the pace, but the average IRR is going to factor in the early years, which is why I'm only at 0.4%, which equates to about a $3,000 gain in policy year 5. The average IRR. And the average IRR does take into account the year I'm making deposits. Because if you just crunch a rate of return, assuming I throw in $250,000 in the first year, and by the 5th year, I've got $253,000, you're not going to get that as far as the average IRR. It does factor in the average IRR formula. It does factor in the actual year when I'm making these payments. All right, so Year 15. Death benefit's about $2 million. Dividend rate, 6%. Annual IRR, 4.1. Average, 3.3. It does get better as the years pass, but do you ever hit 6%? Even on the annual? No, we do not. How about with Guardian? Looking at the internal rates of return. Same break-even point, looks good. But the internal rate of return, you will see a nice jump here. Years 7 to 8. When we execute the reduced paid-up option, which eliminates the base premium, cuts the term rider, cuts the drag on the policy, then continues to grow faster and faster each year. But even when we look at this, what happens? There's your annual IRR. Now, he did have a nice question here, actually. I love when people ask questions I don't think of, because that means they're good questions for everyone else to hear. His question was this, both on the Mass Mutual and Guardian policy, which is, as the years pass, particularly, Steve, when I look at my 80s and 90s here, that annual IRR really starts to go down. Why is that? So if I look at age 80, here's my annual internal rate of return. What happens? Goes down. How about over here? Goes down. Like, why does it decrease? And the reason why is because with a whole life insurance policy, the expenses do increase as I get older. So as I get closer to death, the insurance company will say, as you get closer to mortality, right? If you don't like the word death, the expenses do get higher because they're factoring in, we're going to pay a death benefit claim out soon. So those expenses are going up, and based on the present dividend rate, the expenses just gradually get higher while the crediting rate remains constant. So because those expenses are going up, my net growth rate, the net internal rate of return, is gradually coming down each year. Same thing over here. The thing though to be aware of is with the whole life insurance product, if you don't abuse it and leave a term rider on or do something that just shouldn't be done, with a whole life insurance policy, you should always see that internal rate of return positive over time, meaning this should not start to go south. And the reason why is no matter how high those expenses get with a whole life insurance policy, as I get closer and closer to mortality or death, the guaranteed rate should always exceed the cost of insurance. There's a big distinction there between whole life insurance products and universal life insurance products, because with universal, if I look at indexed universal life, for example, I've got a low guarantee, sometimes a no guarantee, 0%. I'm guaranteed that my money won't go down if it's indexed to the S&P 500. However, the insurance expenses will continue to increase, and what happens with an indexed universal life product is the expenses will exceed the guaranteed rate. That is why when I look at the guaranteed side of a life insurance illustration with an IUL, things go south over time. Whereas with a whole life insurance product, when we look at the guaranteed side of a life insurance illustration, that's not the case. Going back to, let's look at the IRR on this guy. Remember this one for the 40-year-old individual? There's my guaranteed values. When I'm not paying in, or if I'm only paying the base premium, that death benefit will not increase based on the guarantees. So as time passes here, what do you notice on the internal rate of return? Gradually comes down. Does it ever go to 0? No. It'll start to jump up once the policy endows, which is when I hit 100, 99 in this case. But still, even based on the absolute worst case scenario, I will still see it positive over time. Let's go back to our 47-year-old individual. So there are things, or there's the internal rates of return, annual and average. Let's look at the actual dollar amount. What do things look like? Here we go. So we've got the gross cash value growth and then the net cash value growth in this example. So with the Mass Mutual policy, he pays in 50 grand in the first year. He has $44,000 in cash value. I want to hit on something important here. on some life insurance illustrations, you'll see a column called cash value increase. So looking at a different company earlier today, where they had a column that looked just like this, where the first year you pay in $50,000, whatever you have in cash value in the first year shows up in the annual cash value increase column, which it is what it is. Insurance companies, everything is compliant, approved. They're going to do what they're going to do. However, people do sometimes look at this and say, okay, look, my cash value increase this year is $44,000. And when someone points out the next part to them saying, yeah, but you paid in $50,000, which means you took a loss of $5,800, like, oh, why didn't my agent or broker tell me that or point that out to me? That's the kind of stuff, little thing there, but we do need to point it out just to build awareness. Never assume someone knows what we're talking about here. So cash value growth, year 2, paid in 50, the growth was 47,562. It's less than 50. So the gross cash value growth column factors in my $50,000 payment. The net shows how much my cash value is actually growing by and the dividends and interest credited from the insurance carrier. So here, negative $2,400 in year 2, and then I'm positive beginning year 3. And because I'm paying in $50K each year, check this out. Look at year 5, the cash value growth here, $56,371 if I include my payment. If I back my $50,000 payment out, there's my net cash value growth, $63,71. So now I get to see exactly what the insurance company is giving me and not including my own payments. And there I am after 15 years, which when I'm not paying anything in, everything will be equal there. Over here, you'll see the same thing for the first 3 years, negative in the first 2 years, and then cash value continues to grow. The dollar amount too is nice to look at here. If we go back to the last point we were talking about regarding the internal rate of return, as we get really past our 80s, really starts to decline. As I look at it, what it was compared to the last year, it's not growing as fast. So here, if I look at age 80 here, because the annual internal rate of return, maybe it's on a gradual decline, it's not performing at the same level it was before. As I age, I can't run as fast as I used to. Think of it that way for an illustration. But overall, I am still going up. Another illustration is if I'm running a business, maybe I had some years where I was really just cranking and things looked great. However, as I've slowed down and I'm not dedicating as much time to my business anymore, well, it's still growing, but not at the pace it used to. Just to use that example or that illustration. Point is, when I look at the dollar amount, it demonstrates, I don't really care how I slice it. Age 88, it grew by $122,000, which is fantastic. Maybe I just take $100,000 out in income that year if that's what my plan is. Same thing when I look at the Guardian illustration. Not quite as much because I've paid less money into it, but still quite nice. This one was fun. I always like talking about this point. I hope that it made sense. If you have questions on it, certainly let us know or let your agent know or point of contact here at the office. That is, if you are working with us. If you're not working with us, feel free always to let us know. We'd love to work with you. But thanks so much for watching. We'll see you in the next video. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.